Investing young sets you ahead of those who start later in life because of the compounding effect and the fact that the most important commodity is time. And the more time you have, the more chance the compounding effect has to take hold and therefore make your money work for you for a longer period of time. First and foremost, it's really important to have a solid understanding of your own financial goals and key objectives. This will help you to determine where best to put your money and how much risk you are happy and willing to take with your cash. If your time horizon, essentially meaning how long it will be until you need the money, is further afield, for example 30 or 40 years, you can afford to take a little bit more calculated risk than perhaps if you'd need your money sooner. It's also important to understand the different types of investment and their potential risks and rewards so that you can make the most informed choice when you're deciding where to put your cash. Some of the key investment choices, at least kind of under the stock market umbrella, are stocks, bonds, mutual funds, and exchange traded funds or ETFs. When you're buying a stock, you're essentially buying a very small piece of that company. This means that if the company does well, your investment will likely do well, but the opposite is also true, and if the company fails, you could risk all of your money. Therefore, stocks can be a high risk, high reward investment type. This is because the value can fluctuate rapidly, as I said, dependent on how the company performs, but also from broader market sentiment, which is completely out of anybody's control. Bonds, on the other hand, are debt securities usually issued by governments or corporate companies. When it comes to buying a bond, essentially what you're doing is lending that money to somebody else, and then they will pay you back in the future with interest. Bonds are generally considered far lower risk than stocks and shares. However, they do have a far lower rate of return. So again, it's that risk-reward profile. On buying a bond, you'll know exactly how much interest you stand to make and exactly how much money you should have at the end of that bond's maturity. Mutual funds are vehicles that pool money from multiple investors into a diversified portfolio of stocks, bonds, or other securities. By investing in a mutual fund, you're essentially getting exposure to lots of different investment types without having to buy them all individually. The final one on the list is exchange traded funds or ETFs, and this is the primary way by which I invest my cash. ETFs are similar to mutual funds in the sense that they offer you exposure to a wide range of securities by investing in just one product. ETFs, however, are like stocks in the fact that they trade on the stock market, meaning that they can be bought and sold throughout the day. Each of these investments has its own risk profile and potential return. So it's important to do your own research and consider your own personal circumstances before making any investment decisions. Therefore, if you're starting at a younger age, you may opt for a more aggressive, higher risk approach. In addition to the many different types of investments, it's also important to pay close attention to the fees that you'll be charged for investing. This, if not managed appropriately, can eat into your returns over time, thereby reducing the end size of your pot. One of the biggest benefits to starting investing young is the compounding effect. Compounding is the process of reinvesting your earnings, which can lead to exponential growth over time. For example, if you invest £1,000 and earn 10% in the first year, you'll have £1,100 at the end of the year. If you then reinvest that £100 and earn 10% in the second year, you'll have £1,210 at the end of that year, and so on and so on. Over time, this compounding effect can lead to significant growth within your investment portfolio. Another important factor to consider is diversification. Diversification essentially means spreading your money across lots of different investment products to reduce your risk. This can be done by investing in a number of different asset classes, for example, stocks, bonds, ETFs, mutual funds, property, crypto, but also investing across different geographical locations and different sectors. Sector diversification is important because different sectors of the economy can perform differently dependent on a variety of factors. By diversifying across a range of different sectors, you're essentially reducing your overall exposure to just one sector if that sector has any particularly bad news or any massive policy changes. This means that your portfolio will be well positioned for any different economic condition. Geographical diversification is also really important. A prime example of this would be if you held all of your investments in Russia, for example, and then Russia invaded Ukraine. Obviously, if you'd had all of your money within Russia, when stocks and stuff plummeted, you would be highly exposed to that specific area. It's the same if you're investing in any other country. For example, if you invested just within the UK when Brexit occurred, lots of stocks lost lots of value throughout that period of time because there was lots of uncertainty. But the rest of the world performed particularly well. Therefore, that demonstrates the importance of having money across lots of different pockets all at the same time. Of course, diversification alone does not mean that you'll be completely safe and protected from losses. However, by diversifying across different sectors and geographical locations, you are reducing the risk that you're exposed to. This will aid to protect your portfolio from market volatility and ensure that you have exposure to a variety of different opportunities, potentially increasing your returns in the future. When it comes to risk and time, it's important to understand that these two are very closely related. The longer your investment horizon, the more likely you are to ride out any volatility and come out on top in the end. This is why investing young is so important. You have much more time to grow your money and recover from any losses. However, it's important to remember that there is no such thing as risk-free. I mean, if only there was. All investments come with some degree of risk. Therefore, it's important to do your own due diligence and make sure you fully understand what you're investing into before you part with any of your hard-earned cash. Equally, you should never invest any money that you're not prepared to lose, because at the end of the day, it could all go to zero. A well-diversified portfolio of index funds or ETFs is advocated by many professionals, but investing in individual companies, particularly in crypto, especially when you're very new to the process, is incredibly risky and you could lose all of your money. Following this approach without fully researching and understanding what you're doing and the risks is essentially just gambling your money, which of course is never a good idea. One of the safest and most effective ways to invest, particularly within the UK, is through index funds or ETFs. An index fund is a type of passive investment that essentially tracks an index, for example the FTSE 100 or the S&P 500. By investing in an index fund, you're essentially buying the entire market, which means that you have massive diversification, and if one company fails, you won't lose all of your money. This reduces the overall exposure to risk and means that you're more likely to come out on top over the long term. Index funds are also typically low cost, which again means you manage to hold on to more of your money rather than giving it away to a company for fees. Platforms like Vanguard, Trading 212 and Invest Engine are some of the best in the UK at the moment, with Vanguard charging a 0.15% account fee and Invest Engine and Trading 212 both completely free. So when can you start? We've already said that starting as young as possible means that it maximises your investing horizon and means that you're in the strongest position to make as much money as possible. From the age of 18, you can hold investments in your own name, which means you can open your own stocks and shares ISA or general invest account. If you're under the age of 18, you can't actually hold investments in your own name, but you can work with a parent or guardian to open a junior stocks and shares ISA and they can support you in investing. You or a parent can invest up to £9,000 per year within a junior stocks and shares ISA, and when you turn 18, that money would legally become yours because the stocks and shares ISA will also be linked to yourself. Let's say you plan to retire a little bit early at 60. Starting as early as possible would reduce the amount of money that you would actually have to invest yourself and make it easier to be able to retire early. If you invested just £200 per month and started at 16, 18, 20, 30, 40 and 50. This is how much money you would have at the age of 60. This assumes an average annualised rate of return of 7% per year, which is indicative of the market's historical performance. As you can see, it's pretty clear. Time is the most valuable asset that you have when it comes to investing. Overall, investing young is a crucial step for your own financial future. It's something that I wish I'd started earlier than I did. By starting early and taking a long-term approach, you can benefit from the compounding effect. But remember, it's important to fully diversify to reduce that risk. And when it comes to investing in the UK, the US or anywhere for that matter, investing in index funds or ETFs is one of the most proven and effective ways to meet your financial goals. This is essentially what people hold within their pensions, which again is kind of the massive institutional side of investing. If this has stoked your appetite and you want to get started, there's the new tax year just started now, so why not go and open up your brand new ISA and have absolutely no tax ever to pay on any of those investments. If you're not sure where to open your ISA, check out this video next where I break down the best ISAs, the cheapest ISAs and the ones which potentially could be the right choice for yourself. And if you want to see my portfolio, how it's grown over time and where it finished at the end of the last financial year, check out this video next. I'll see you in one of them soon.